Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report brought to you in association with ASB. Today I want to look at the shareholder letter sent out by Warren Buffett from Berkshire Hathaway. Now this guy's 78. He really is the world's most renowned investor, and every year he comes out with his letter to shareholders, and it's well worth a read to give you an idea of what the world's most renowned investor thinks about the world. And this time he said something very interesting about the US Treasuries market. And I'll explain how that affects people in New Zealand. He said that the US Treasury market was in a bubble that was at least as bad as the Dotcom bubble of 2000 and the housing bubble of 2005, 6 and 7. So what's he talking about here? Well, the US Treasuries market is the market for government bonds, US government bonds, and it's the deepest market in the world. There's a lot of US government debt out there at the moment. And what's happened over the last year or so is that the yield for, let's say, the 5-year Treasury, the 5-year US government bond, has dropped below 2%. In fact, it got down as low as 1% earlier this year. Now, why does this matter? Well, New Zealand government bond yields tend to be, and in fact every other bond in the world, tends to be based off what the US bond yield is. So you have a series of bond curves, and all of them are based off what's happening in the US. And for most of the last 6 to 7 years or so, New Zealand's 5-year bond yield was around about 6 to 7%. Now it's down at 3.8%, and that's because it's followed down that yield in the US Treasuries market. So what happens if, for example, the bubble in the US Treasury market were to burst? Well, the 5-year US Treasury, we think, would probably rise to around about 4% from just under 2% now. And that would effectively bump up all long-term interest rates around the world by about 2%. So let's have a look at how that translates into people's mortgage rates at the moment. Well, we start off at the bottom of the pile, if you like, with the US yield at the moment about 1.8%. About 2% above that is the New Zealand government bond at 3.8%. Then we have what we call a swaps market, which is the wholesale market. That's at 4.2% at the moment. And when the banks go to borrow money from offshore, which they'll have to do, they tend to pay around 150 basis points above that swaps curve. Then at the moment, they're having to pay a 90 basis point fee to the government for the government guarantee. So all up, it's costing the banks around about 7% to fund for those 5-year mortgages that they give to us. Now currently, it's hard to believe, but currently the 5-year rates being offered by the banks are about 6.5%. So essentially they're selling it to us at below cost, and that can't last. And what that means is if the US Treasury bubble were to burst, interest rates in New Zealand would rise by about 2%. So currently our 5-year rate is around about 6.5%. You'd have to see it go at least to 8.5% to 9% if the US Treasury market bubble were to burst. And that's why we think, longer run, long-term fixed rate mortgages, the rates on those are likely to increase. And we're likely to see the short-term rates, the variable rates and the 6-month rates, they're likely to fall again as the official cash rate is cut. So what this means is we're going to see a positive yield curve and a steeper yield curve. For those in the interest rate markets, that's something they look at closely. And it's going to encourage a lot of switching, and we've already seen that, from fixed rate into variable rate. And for those people who are looking really for the cheapest deal at the moment, at least for the foreseeable future, and that's only about 6 months or so, you'd have to say that variable rates are going to be cheaper. And you'd have to say too that if you really wanted to lock in for 5 years, let's say for a specific reason you wanted to be sure about what you were paying out, then those 5-year rates, I think, aren't likely to fall much further than that 6.5% now, and if they may actually rise over the next 6 to 12 months. There we have it. Warren Buffett, the Treasury bond bubble, and what it means for New Zealand borrowers. I'm Bernard Hickey with a special report brought to you in association with ASB.